This is Nauta AI News. Today, we are looking at the week AI shifted from model hype into economics, deployment, money, and hardware. The headline is the AI price war. DeepSeek is making its 75% discount on its flagship V4 Pro model permanent, according to reporting picked up across the tech press. That matters because it changes the baseline assumption for anyone building with model APIs. A discount that was temporary can be ignored. A permanent price reset becomes a market signal. For users, cheaper model access means more products can afford to run AI features continuously instead of treating them like expensive demos. For startups, it raises the pressure to build around distribution, workflow, and experience instead of only promising better output. For the larger labs, it creates a harder pricing question. How much premium can a frontier model keep if capable alternatives keep compressing the cost curve? But the price war is only half the story. OpenAI launched the OpenAI Deployment Company, a new organization focused on helping businesses build and deploy AI systems. OpenAI also said it agreed to acquire Tomorrow, an applied AI consulting and engineering firm. That is not just a services announcement. It shows the center of gravity moving from access to implementation. For the last few years, the AI market was mostly about who had the strongest model and who could get developers onto an API. Now the question is different. Who can get AI inside actual business processes with enough reliability, governance, and integration that companies keep using it after the pilot ends? The deployment company is OpenAI saying that model intelligence is not enough by itself. The real commercial battle is production. That should also tell us something about the broader AI cycle. If the leading labs are building deployment arms, the industry is admitting that adoption is messy. Companies do not simply buy a model and become AI native overnight. They need workflow redesign, data access, controls, security reviews, training, and integration with old systems that were never designed for autonomous software. The winners may be the companies that make that transition feel boring enough to trust. Meanwhile, the money race is still enormous. Anthropic is reportedly working on a funding round that could exceed $30 billion and value the company above $900 billion. Even if the final numbers move, the direction is clear. Investors still believe frontier AI companies can become one of the defining infrastructure layers of the economy. That level of financing says two things at once. First, the cost of competing at the frontier is massive. Training, serving, talent, safety work, data, partnerships, and compute commitments all require deep capital. Second, the market still believes there may be a small number of very large winners. The open question is whether those winners are model labs, cloud platforms, device companies, application companies, or some combination that has not settled yet. And then there is hardware. Cerebras priced its public offering at $185 per share, raising billions and becoming one of the biggest AI hardware moments of the year. The company later announced the closing of its initial public offering, with shares trading on Nasdaq under the ticker CBRS. This is important because the AI boom is not only a software story, it is also a capital market story about chips, power, memory, data centers, and who controls the physical layer. Cerebras is not NVIDIA, and it does not need to be for the story to matter. Its IPO shows public market appetite for alternative AI compute. Investors are looking for ways to bet on the infrastructure underneath the AI boom, not only the chatbots on top of it. When specialized chip companies can raise that kind of money, the market is telling us that compute scarcity is still one of the defining constraints. That is also why takeover interest around companies like Tenstorrent matters. Reports that major chip incumbents have shown interest are part of the same pattern. The AI hardware market is consolidating and expanding at the same time. Big companies want more control over accelerator roadmaps. Startups want enough capital and distribution to survive the enormous cost of competing. Customers want more options because depending on one supplier for the future of AI is a risky place to be. So when we put the week together, the story is not simply cheaper AI. It is a more complicated market. Model prices are falling. Deployment is becoming a product category. Frontier labs are raising extraordinary sums. Hardware companies are moving into public markets and acquisition conversations. The industry is maturing, but not calming down. For everyday users, this means AI features may become more common and less visibly expensive. For businesses, it means the hard part is shifting from trying AI to operationalizing it. For developers, it means the model is only one piece of the stack, and for investors, it means the AI boom is spreading across software, services, chips, and infrastructure all at once. The biggest question now is whether lower model prices expand the market faster than they compress margins. If AI gets cheap enough to be everywhere, the value may move toward the companies that own workflows, data, devices, distribution, and trust. If frontier capability remains expensive and scarce, the largest labs may keep extraordinary pricing power. This week gave us evidence for both sides. That is why this moment is worth watching. AI is not slowing down. It is becoming more economic, more physical, and more operational. The news is no longer just which model scored higher on a benchmark. The news is who can make AI cheaper, who can deploy it, who can fund it, and who can build the hardware to keep it running. That is Nauta AI news.